Well, what does Bob Froehlich, Senior Managing Director at Hartford Financial Services, think? Well, that's why we have him. Bob, it's good to have you with us. Thank you very much for coming by.
It's good to be here.
So what do you think? You hear this news. You heard the Stanley Works Black & Decker deal yesterday after the close. You hear the Berkshire Hathaway news with Burlington Northern today. What does this indicate to you about stocks?
Well, I think it's a very good indicator for stocks, but it's indicating two different things as well, because there's two stories behind the stories here. But the bigger story that both of them transcends it is, look, it's one thing for someone to hire employees to buy a computer. It's another thing when you're buying another company. To me, it's the highest proxy for confidence. So it tells me there is business confidence out there, investor confidence. That doesn't mean the market hits new highs every day, but that's a catalyst that you're looking for. So I think these deals are very interesting from that perspective. But what I really love about the deals is when you peel back the onion, so to speak, especially let's look at the Warren Buffett deal. I mean, you know, we had a railroad industry that 10 years ago basically was in disarray, and a lot of improvements. It's much more efficient now. And I think it's Warren Buffett saying, and not just that I'm investing in America, but he's the greatest value investor out there. So if the market was really going to correct another 10 to 15%, do you think Warren Buffett would be doing a deal today? No, he'd be sitting on the sideline. So I think there's a story behind this story that says, for all you investors out there waiting for the Dow to be at 7,500 so you can get back in, you might not have a chance to do that again. So, I mean, I think that's a big catalyst. We've got to have some way to get all the goods we buy in China all over the United States, and I think the way it's going to happen is in the railroads.
All right, let me put it to you, though, that were you surprised when the market opened today that we didn't see stock prices rally, given the fact that we just had these two multi-billion-dollar deals?
Not surprised. I was shocked. I mean, you would have thought in any other circumstance
that this would have been a vote of confidence for the market. People would have all pulled in people who are on the sidelines.
And I think it's saying two things to me. One is that there is some concern that the market may have moved too soon, too fast. I mean, that's just been a heck of a run we've had from March till now. So I think there is concern and some profit taking. And the other thing, that there probably couldn't have been a worse day to have this happen than have it in the two-day period when the Fed is meeting and everyone's so concerned.
And everyone's waiting for those employment numbers on Friday.
So it was just bad timing. But I think the one thing is it does set the catalyst going forward. These are potentially industry-changing events that are going on. So I think there will be a catalyst for them. Maybe it's something that drives the market in the middle of the month as opposed to the first part of the month.
All right, step back and tell us about what you're thinking when you look at third quarter earnings, because it seems as though we're getting a situation where third quarter earnings, a lot of companies, they are coming in, they are actually exceeding estimates both on the top and the bottom line, but a lot of those estimates, I mean, truthfully, are pretty meager.
Well, the good thing, Pimm, as you know, you've been around a long time as well. If you set the bar low enough, even you and I can jump over it. That's the story. I mean, the expectations were so low. To me, the significance of this earnings season, it sets the stage for next earnings season with the top line revenue growth. I knew we'd have okay numbers with the bottom line, but I will tell you where I have been surprised with the diversity of the top line revenue growth. We're seeing some of it coming from inventory rebuild. We're seeing a lot of it coming from growth outside the United States with the global marketplace, and we're seeing the consumer selectively not quite as bad as people thought. I mean, still a long way from coming back.
Faith in the U.S. consumer.
I still have faith in. Didn't come back as strong as I thought they would, but it's the diversity of that top line revenue growth that I think might be the bigger story.
What about jobless rates when we look at Friday's number?
You know, I mean, it's still the catch-all that's going to, I think, keep people on the sideline. I don't think we're anywhere near recovering yet. I think the number is still going to be a bad number. I think that.
But does everyone already expect that? Well, so it's not going to have that much of an effect?
I think, there's some mixed signals on the streets right now. Some people think that maybe this thing's going to turn around sooner. I think we're looking at another 5 to 6 months of bad unemployment numbers. I think the unemployment rate before it starts heading down is probably going to be above 10.5%, which is bad if you're unemployed. But if you're an investor, that's good news because the Fed's on hold. There's no way the Federal Reserve, I don't care what their language is tomorrow, there is no way the Federal Reserve Board does anything with double-digit unemployment in this country. That is bullish for the stock market.
How long? What are they going to do? They're going to wait and see what happens to unemployment before they do anything?
I think that the Fed is basically on hold for exactly a year. And my take is this. With double-digit unemployment until the next congressional election, which is November, you got 535 people going to their home territory. There's no way they can defend raising interest rates.
Politics trumps all.
It always does. We pretend it doesn't, but it's too big of, because it's always easy to stop the economy. There's no harm in letting it go a little long. All he has to do is what Paul Volcker used to do. Just raise it 75 beeps at a time when we didn't think it's coming. So he can get it back, but I think that sets a bullish stage for the market. I don't think there's any scenario the Fed can do anything for another year.
You're not worried about, let's say, another stimulus package coming down the pipe?
We don't need one because of the $787 billion stimulus package they passed. They've only spent $100 billion. For goodness sakes, I don't need another one. Just spend the money you have. Oh, and isn't it a coincidence? It'll all be spent next year when all 535 are running for re-election. I'm not sure if there's a theme going on here.
You're betting on politics, and that's one way to play the market.
I think the public policy issues are an extremely important issue in the market, and I think it's something a lot of investors don't focus on. We tend to not focus on what we don't understand, and so we discount what's going on in Washington. Never discount what's going on in Washington. They have more control over your money than maybe we do.
Last question, then we're going to take a break, then we're going to continue the conversation. What about the U.S. dollar? Are you concerned there, though?
It's going down. It's not going up. It's back to your first question. The Fed is not raising rates anytime in the next year. The rest of the world will probably start raising rates, so that's, in essence, going to put more pressure on the dollar. For anyone that made money on the dollar the last couple of days, take the money off the table. That was a head fake. You're not going to make money. The dollar probably goes down another 5, maybe 7%. But the good news is, because the dollar is going down, we don't have a trade deficit anymore, and so now we have a dollar problem. But so we'll fix the dollar problem when we raise rates and probably cause a treasury bond bubble.